As of 10:48 a.m. Eastern Time, with the market live and in motion, Netflix is trading at approximately $1,091.50 per share. This represents a clear intraday pullback, putting the stock down about $8 from its previous close. The stock opened this morning at $1,099.99 and has since been caught in a fairly tight channel, operating within a day's range of $1,086.68 on the low end and $1,104.60 on the high end. This choppy, downward-biased action comes just as the retail crowd is getting excited because the company just announced a 10-for-1 forward stock split scheduled to trade on a split-adjusted basis starting November 17th. This is the kind of news that typically gets investors energized, creating the expectation of a new wave of accessibility and upward momentum. But the reality of today's price action shows a market that is far more concerned with a different set of numbers. While many are focused on the split, the institutional holders who control nearly 98% of the float are still digesting the complex reality of the company's last earnings report, a report that was far from the clean beat everyone had priced in. The common belief, the narrative you'll see pushed on social media, is that Netflix has successfully navigated its challenges. It cracked down on password sharing, and not only did subscribers not revolt, they grew. It launched its ad-supported tier, which is now scaling beautifully and is on track to double its revenue this year. From that perspective, Netflix looks unstoppable, a fortress of content and monetization. The expectation is for a smooth ride back to all-time highs. The reality, however, is that this fortress is incredibly expensive to maintain, and the market is showing signs of intolerance for any unexpected costs. The last quarterly report on October 21st was the perfect example of this tension. On the surface, revenue was solid, coming in at $11.51 billion, right in line with forecasts. The problem was the earnings per share. Wall Street was looking for $6.96. Netflix delivered $5.87. That is not a small miss. The reason for the miss is the entire story. It wasn't a failure of the business model. It was a sudden, one-time $619 million tax charge related to a long-standing dispute in Brazil. The stock immediately sold off over 6% in after-hours trading when that news hit. Now, the bull case argument is that this was a one-time accounting hit, that it should be ignored, and that the core business remains strong. In fact, management even noted that operating income would have exceeded forecasts if not for that charge. This is true, but it reveals the deeper risk in holding a stock that trades at a price-to-earnings multiple of over 46. At this valuation, there is no room for error. There is no tolerance for one-time charges, Brazilian tax disputes, or any other unexpected friction. The stock is priced for absolute perfection, and the third quarter was a stark reminder that the real world is messy. This is the gap between expectation and reality. The expectation is flawless growth. The reality is that international expansion carries complex, unpredictable regulatory and tax risks that can wipe out hundreds of millions of dollars in a single quarter, and that risk is not fully reflected in the current stock price. Let's look at the current trading environment. The volume today is tracking slightly below its recent averages, suggesting a lack of conviction from both buyers and sellers as they wait for the next major catalyst. The stock is currently trading below its 50-day moving average, a level it has struggled to firmly recapture since the post-earnings dip. This suggests that while long-term institutions are holding, new buyers are hesitant to initiate large positions at these levels. The recent insider activity, while not alarming, has also been noted. The chief financial officer, Spencer Newman, sold a small tranche of 220 shares on November 3rd. This was a tiny, pre-planned sale, but it contributes to the narrative that insiders are not aggressively buying at this price point. The focus is squarely on the ad tier, and whether its growth can justify the valuation. Recent Comscore data is incredibly bullish, showing that Netflix's ad-supported plan now accounts for a staggering 45% of all viewing hours in U.S. households, a massive leap from 34% last year. This is the primary bull thesis. The question is not if the ad tier is working, it clearly is. The question is whether the revenue from those 94 million global ad tier users, which comes at a lower average revenue per user than the premium tiers, can grow fast enough to offset the slowing subscriber growth in mature markets and, more importantly, the astronomical content spend, which is slated to remain in the $17 to $18 billion range annually. This brings us to the stock split. It's important to be perfectly clear about what this 10-for-1 stock split, effective November 17th, actually does. The expectation, particularly for newer investors, is that a lower share price, around $109 post-split based on today's price, will make the stock cheaper and attract a flood of new retail buyers, pushing the price up. The reality is that a stock split changes absolutely nothing about the company's fundamental value. The market capitalization remains the same. The PE ratio remains the same. Your slice of the pie is simply cut into 10 smaller pieces. The company's own press release stated the purpose was to make shares more accessible to employees in their stock option program. This is a move focused on employee compensation and liquidity, not on financial engineering to boost shareholder value. While it might generate some short-term buzz, institutional investors, the ones who actually move this stock, are entirely indifferent to it. They're looking at free cash flow, operating margins, and the amortization schedule of that massive content library. What's your take on this? Comment below if you think the 10-for-1 stock split will have any real, lasting impact on the share price, or if it's just a cosmetic change. Now, let's discuss the short-selling activity in Netflix, because this is a topic surrounded by a lot of misinformation. When a stock has a high valuation and a passionate bull versus bear debate, many retail investors automatically assume it's a heavy short and a candidate for a squeeze. The data, however, tells a completely different story. The expectation is that a stock this controversial must be under attack by short sellers. The reality is that currently, Netflix has a very low short interest. As of the last reporting period, the short interest as a percentage of the float is only about 1.44%. This is an extremely low number for a mega-cap tech stock. This means that all the bearish bets against the company only add up to about 6.05 million shares, out of a float of over 420 million shares. Furthermore, the days to cover, which measures how long it would take for all shorts to buy back their shares, is less than 2 days. This is also very low and signals high liquidity. This data is crucial for investors to understand. You can find this information directly on financial portals like Fintel, or by checking the official FINRA and NASDAQ short interest reports, which are published twice a month. A low short interest and a low days to cover mean there is virtually zero statistical chance of a short squeeze in Netflix. Any online chatter calling for a squeeze is completely disconnected from the actual market data. The cost to borrow Netflix shares is also incredibly low, sitting at around 0.25% annually. This is the fee that short sellers pay to borrow the stock, and a rate that low indicates that the lending market is saturated with shares available to borrow. There is no pressure on shorts whatsoever. So, what is the short thesis? If they aren't trying to squeeze it, what's the bear case? The short thesis for Netflix is not a bet on bankruptcy. It's a sophisticated fundamental valuation argument. The bears, which are primarily large hedge funds, are simply betting that a 46 PE ratio is too high for a company whose revenue growth is maturing. They look at competitors like Warner Bros. Discovery or Comcast, which trade at price-to-sales ratios under 1.5, and then look at Netflix trading at a price-to-sales ratio of nearly 11, and they make a relative value bet that this gap must eventually close. They are shorting the valuation, not the company. This is a critical distinction. Do you think the bears are right about the valuation, or is Netflix a unique company that deserves this premium? Let me know your thoughts on that. Looking forward, the outlook for Netflix is balanced on a knife's edge. The company's future trajectory depends on 3 key factors. First, the continued scaling of the ad-supported tier. The 45% viewership number is fantastic, but the market needs to see that translate into high-margin revenue that moves the bottom line. Second, international execution. The Brazil tax incident proves that growing in emerging markets is fraught with risk. Investors will be watching for any signs of similar issues in other key markets like India or Southeast Asia. Third, content. Netflix has to keep producing global hits from Squid Game to Stranger Things just to keep subscribers engaged in the face of intense competition from Disney, Amazon, and Max. This content treadmill is relentless and expensive. The bull case is that the ad tier provides a new growth engine that the market is still underappreciating. and that as interest rates presumably fall, a high-growth name like Netflix will command even higher premium. The bear case is that the stock is already priced for perfection. Growth is structurally slowing in its most profitable markets, and the $619 million tax surprise was a warning shot that the path forward will be much bumpier than the bulls believe. To summarize, the market's expectation is that Netflix, with its new stock split and booming ad tier, is on a clear path upward. The reality we're seeing in today's trading and in the fine print of the last earnings report is a market that is deeply concerned about valuation and execution risk. The stock is priced as if nothing can go wrong, but the third quarter just showed us that things can and do go wrong. The short sellers aren't the enemy here. They are simply the other side of a very rational debate about what a mature, dominant streaming company is actually worth. The stock split is a distraction. The real story to watch next week will be the institutional money flow leading up to the split's execution date, and whether buyers are willing to step in